Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday. Happy Friday, everyone, and it is August 28th. We got a lot of data to go over today, so we're just going to jump right into this. So we'll start off with the personal consumption expenditure for the month of July. This is inflationary data that we look at on the consumer level. The core PCE, which is what you'll see below, is also known as the core real inflation, and this is the gauge for inflation that the Fed looks at when we look when we when we're talking about inflation out there. And so we'll talk about that here in a second. But to begin with, we'll start with the personal consumption expenditure, which rose a 0.5% back month over month in June. And in July, it rose 0.3%. So what that did on a year-over-year level brought us from 0.9% to 1%. So if you recall, back during the pandemic, we basically went to almost to zero, and thankfully it didn't drop into negative territory, which would be stagflation or deflationary data, which would not be a good sign for anybody. But it is steadily rising, which is a good sign there. We also got the core PCE, which is when you strip out food and energy, which are two variables that you cannot control. This is the number that the Fed will use in determining its inflationary data when they're looking at rate hikes or cuts. So it's year over year, or I'm sorry, it's month over month. In June, it went up 0.3% and did the same thing, same pace in July. So its year over year went from 1.1% to 1.3%. Now to move on here, we also got consumer spending for the month of July. In June, we had a nice increase at 6.2%. However, in July, it was supposed to drop a little bit to 1.5%, and it came in at 1.9%. Now, some of this, there's some speculation. It might be those who are unemployed or these things that are kind of holding on to their money a little bit longer as they're approaching, the forbearance that was supposed to be finished in the unemployment was supposed to finish up in end of July. So we're kind of watching some of this that's going on right now. On the other hand, we also got personal income for the month of July. It dropped 1% in June, and the forecast comes for a 0.2% drop in July. However, it increased by 0.4% as more and more people are going back to work in these months. So let's jump ahead to the next one. Is we got the Chicago PMI. This is manufacturing in the Chicago region. Anything above 50 on this index indicates expansion, and then anything below it, of course, is contraction. So in July, it went from 51.9%. Forecasters calling for a slight improvement to 52, and it had a slight drop to 51.2%. Last but not least, we got the consumer sentiment for the month of August. In July, it went at 72.8. Forecasters calling for the same rate at 72.8, and however, it came in a little bit higher at 74.1% or 74.1. Let's jump ahead here to the headline news. Stocks are up. It's taken a lot of the effects are taken from the effects of the Fed's policy change yesterday. Touch a little bit base on that. If you missed yesterday's report, the Fed had decided to go from a target rate of 2% to do an average. So instead of keeping a hard number at 2%, they are going to do an average. Now, this could have a lot of effects. This could be good, obviously, for stock market because the stocks they don't want the Fed coming in putting cold water when the market heats up. They're going to allow the market to heat up a little bit, but they're also kind of saying that this is going to be more of a moderate. Now, to take a look at this a little bit further, if you look at the last 20 years, we've been averaging approximately 1.5% on the inflation on that. So it's much lower than that of the Fed's target rate. Now, if we go above that 2%, let's say 2.5%, and we're looking at something like mortgage-backed securities or bonds, this could have the adverse effect of what we're thinking of. Now, you're hearing on the news that this is going to leave the Fed with low rates on there, but this is what they call the Fed funds rate, which is, and then you got prime. These are short-term rates that they're talking about here, not mortgage rates. Mortgage rates are over a 30-year period, and when you have inflation coming in there, it erodes the value of time over the value of the mortgage-backed securities or bonds. And so inflation is that of an enemy, so to speak, of that. So this could have the adverse effect for mortgage rates, which could increase it. However, one thing that's kind of offsetting this is that the Fed has been buying mortgage-backed securities, propping up these lower mortgage rates, which is kind of helping us right now. This could obviously down the road change a little bit when the Fed stops buying some of these mortgage-backed securities, because at some point they need to start unloading their balance sheet, or their balance sheet is just going to be too high. They don't want to be holding on that much debt, which is not good for them. So let's try to figure out what's going on going forward. We'll have to kind of wait and see. But again, another aspect of this Fed policy change is that a lot of investors were wondering about why it's being introduced now at this Jackson Hole virtual webinar versus at their next policy meeting in September. They think that they did this earlier to set up the framework for the next announcement during that meeting here, and we could see some more announcements or talk about what's going to happen at after that meeting when they give their announcement. So stay tuned. There'll be probably more to come in terms of what the Fed's thoughts and plans are going to do. They've been pretty good about. They've given us clues about this for quite some time here, and I think it just kind of took people off guard about that they're actually making this as a policy change on there. Just a side note here, Japan's Prime Minister Abe is deciding to step down because of sickness. He's going to stay in office until they get somebody else in there to replace him. But unfortunately for Prime Minister Abe, he's going to be stepping down due to illness. He's due to be in there for another year, but due to illness, he's going to have to take a back seat and let somebody else fulfill that position here. Let's see how bonds are doing, mortgage rates. We're up a little bit. As you saw, we kept going out and we went below the 50-day moving average. We dropped about 25 basis points when we left out the previous day. Right now, we're up about 14 basis points, just breaking above, again, this 14-day moving average. We'll have to kind of wait and see. Now, pricing, because it's been a little wacky lately, it's not that much different. We got probably a little better pricing. We had in some cases, some people had 2 price changes yesterday. So we're probably going to be in the middle there. So price changes as to the worst. So they're probably going to be slightly better than yesterday's close pricing, but somewhere in the middle from where they opened and that of where they closed yesterday is probably where they're going to sit. The volatility of the market, a lot of lenders will probably take a more conservative approach, especially heading into a weekend. They're probably going to want to kind of wait and see and not get too much there, so to speak. Let's see how yields are doing. As expected, yields are adding more pressure to it. As you can see, we broke above this level that we talked about that was important, the 0.73 range, and touched all the way up here, and then closed way up there, almost like 0.77 or so. We started that way. We challenged this, which was our ceiling, now is our floor now, and has pulled back, still continue above it. So we're just above the 0.73 level right now. And we kind of want to see if we can break below this, because this is what's adding more pressure to mortgage-backed securities and bonds as we go forward. So mortgage rates are essentially to wrap this up. Mortgage rates are about the middle where we were yesterday. We're not at the best levels that we were yesterday, or we're not the worst levels, kind of in the middle of where we should be at pricing wise. I hope that kind of makes sense for you, because as you guys probably aren't watching these rates throughout the day, as we had for the most part like 2 price changes due to the continuous drop, you're going to probably be more in the middle of where we were, as today's highs or increases kind of are helped improve that a little bit. If you guys want to stay tuned, you guys want to learn more about information on mortgages and buying and refinancing, I'll leave you a link to my site. Also, you can find that in the description below. If you need to reach out, talk about any information you want to learn about refinances or purchasing, we can help you with the pre-quals or refinances. I am a loan officer, and the lender I work with is a national lender. We could certainly accommodate those in other states as well. Please feel my information will be on that website. You feel free to reach out to me at that point. We can certainly discuss how we can assist you. You guys have a great rest of your day. Enjoy your weekend, and we'll see you on Monday's video. Bye-bye.